Hey everyone, what's going on? It's Lucid speaking. So on this video, I'm gonna be showing you guys. I'm gonna be teaching you guys market nature, the nature of price, right? So let's dive in directly into what we have today on this video. So what is market nature? Market nature is the phase price is currently on. So we have two phases of market nature. We have the impulsive phase and we have the corrective phase, right? We have the impulsive phase. We have the impulsive phase, which is its first leg. We have this corrective phase, which comes as a pattern, and then we have another impulse as a continuation. Once you get this impulse correction, then you should expect a continuation, right? A continuation to the upside for an uptrend at an impulse correction and a continuation to the downside for a downtrend. Then that's market nature for continuation, for trends continuation, right? Then we have market nature for trend reversal. You should have an impulse to the upside, a correction to the upside, a weak correction to the upside. This correction shows weakness in price, shows weakness in buy power, then a break below and a continuation to the downside. That's in the opposite direction. That's market nature, uptrend to downtrend, and market nature downtrend to uptrend. You must see an impulse to the downside, a correction, and then a break above, impulse to the upside. That's market nature reversal. So this is for trend reversal and this is for trend continuation. Impulse, correction, impulse to the upside. Uptrend continuation, impulse, correction, impulse to the downside, downtrend continuation, then impulse, weak correction to the upside. You see, impulse to the upside, weak correction to the upside, and then break below, reversal to the downside, impulse to the downside, weak correction to the downside. Once it breaks below, we get a continuation to the upside. So without wasting any much of your time, let's dive into the chart and show some live examples of the market nature. So right, so you can see what's been going on here, right? Let's see what's been going on here. We have our impulsive leg. We have our impulsive leg here, and we have our corrective leg. Impulse, correction, then reversal. Remember what I said, correction to the downside signifies a potential reversal, right? It's not 100%, it's probability, potential reversal. There are possibilities that a reversal might occur. Then we had an impulse here, a correction, right? Then a push to the downside for another correction, a push to the downside for a bigger correction, right? Then a push to the downside, right? So impulse, correction, impulse, correction, right? correction to the downside. Let's zoom in quicker for you to see what's going on. You get an impulse here, correction to the downside, another impulse, another correction here, another impulse, a very huge correction, then another impulse, right? So I had to change these lines, for it to look more solid, right? So this is a correction. After this huge impulse, this is a correction, then give another impulse, then this impulse give a correction to the upside, right, which signifies a reversal. You see now, signifies a reversal. Then price dropped, then gave a correction after the impulse, then dropped again, right? So this is a correction to the downside, right? Impulse, correction to the upside, another impulse. Then this leg is one whole impulse on a higher time frame, let's say a 3-day time frame or a weekly time frame. So impulse, correction, right? Continuation. Then within this pattern, this correction, you can get another impulse, uptrends, correction, then reversal, right? Then we had another impulse, then we got another correction, right? Another correction, impulse, correction, impulse. Then we had this huge correction. Right? So this is the nature of price. This is what price does. This is market nature. This is the nature of the market, right? So impulse down, correction to the upside, impulse down, correction, impulse down, correction, impulse, correction for another impulse, for another correction here, correction here. Then we got our continuation, impulse down. Let's take a look at this, impulse down, correction. Actually, this is the second time I'm making this video. I realized I didn't plug my mic in while recording the first video. Impulse down, correction to the upside, anticipating another impulse to the downside, right? Short position, another impulse to the downside or more, right? So yeah, that's exactly what we should be doing on this chart, right? So let's get more examples of this. So you can see this huge sell-off after this impulse to the upside, impulse to the upside, correction, and continuation, impulse to the upside, correction to the upside, right? Before this huge sell-off. Now impulse, correction, impulse, little corrections, impulse, little corrections, impulse, huge correction, right? Huge correction, huge correction for another huge sell-off. Just take a look at this. Right, so this is just it. Impulse, impulse correction, impulse correction to the upside, impulse pullback. This pullback is also a correction. Impulse pullback, little impulses, pullbacks. This correction, this huge correction here was a correction for this whole impulsive leg, which then pushed price down, did a little sideways correction, pushed to the upside, impulse pullback, impulse pullback, impulse pullback, impulse pullback, impulse correction to the upside, drop, impulse pullback, impulse. So this was a pullback for a correction, a huge correction, a huge correction. This was a huge correction for this impulse, then a sell-off, then we had this huge impulse, then a correction here, this impulse correction here, impulse correction here, impulse. Okay, we had this downward impulse and we had this correction, impulse, correction, impulse, but then we had little movements within impulse, correction to the upside, reversal, impulse, correction to the downside, continuation, impulse, correction, impulse. Alright, impulse, correction, impulse. Then we continue to drop down, right? So so let's talk about stops and targets while trading with this. What should be your stop? What should be your target? Right? So when trading this, you should have your entry price here. You should have your entry price. Your entry should be here. Your stop loss should be below this pattern, right? And your take profit should be this leg. The calculation of this leg. Calculate this leg here, this leg, and then that should be your target, right? That should be your target. So when should you be taking this trade? You should only buy or sell when it has been confirmed, when price has broken this trend, right? So you should only take the sell when the sell or buy, or the trade when price has already broken the trend line. That's your confirmation, right? Or sometimes you can get a correction after the break of the trend line, just like this impulse correction you can take from here. So but there is this trade touch rule that once price make a third touch on the trend line, it's going to blow off. There's probabilities and possibilities that it's gonna blow off. You know, all these things, they don't happen every time. Sometimes it just gives two touch, 1 2, and then takes off. Sometimes it completes it touch 1 2 3 below and blows off. Once you know that pattern is a continuation pattern, you should just wait for 3 touches below before taking the trade. 1 2 3, blow off. 1 2 3, blow down. 1 2 3 to the upside. 1 2 3. So that's what you should be waiting for. Sometimes you can take the trade at this point. Sometimes you can take the trade at this point with your stop loss still below. It's a risk entry, right? A risk entry, while taking the trade from the break is a confirmation entry, because you have confirmed the move to the upside. So then again, what this does is that this risk entry will give you a tighter stop, a lower stop loss, right? It gives a lower stop loss, but then it hasn't yet been confirmed. The continuation has not yet been confirmed. But once price breaks this trend line, means that the continuation has been confirmed, and then you have less chances of hitting stop loss, right? Let's say you have this. It's basically the same thing, because you're risking less, but you're gonna lose more because price hasn't been confirmed, right? The uptrend, the trend hasn't been confirmed yet. The movement, the push, the break of that nature hasn't been moved. So you should only trade during the corrective phase. You should look for opportunities. You should never trade during the impulsive phase, because you can be taken out at any time by surprise. You should only trade during the correction, right? So remember, I'm not a financial advisor. Don't take don't take any of this serious. You can actually go back and backtest this for yourself. Check multiple places where it played out and where it did not, where it didn't play out, and know how to manage this for yourself. Make an edge with it, and yeah, it's gonna be okay, right? So test this for yourselves, and don't just treat this blindly. You understand? Test this for yourself. Test this for yourself, guys. Go test this for yourself. Go test this for yourself. All right. This is I think this is either 4 or 5 a.m. in the morning. Okay, it's 5:07. Right. Go test this for yourself, guys. Go test this for yourselves. Oh, go test this for yourselves. Alright, this is yeah, guys, I hope you enjoyed this video. I hope you understand, right? I hope you really understand what I'm trying to explain. Well, impulse correction, impulse correction, impulse huge correction to the upside, right? Then push to the downside. Well, guys, don't go trading this blindly. Test it, back test it for yourselves. Correction to the downside. 1 2 3 break to the upside, right? So 1 2 3 break to the upside, 1 2 3 expecting a break to the downside. Well, yeah guys, see you on the next video. Peace out.